based in NYC. Gaia has over $3 billion of assets under management with 18,700 residential units and office buildings. Ladies and gentlemen, please welcome Mr. Danny Fishman. Shaking hands before battle. Thank you very much. So, Mr. Yasa, we're gonna start this with a very softball. What do we look into, like with the world state of real estate? What's going on right now? Press the button. Yes.
Thank you. First I'd like to thank everyone, especially Alea Group for inviting us yet again this year in Saudi, and I welcome everyone to a little bit this way. Welcome everyone to Riyadh, and it's really been a dramatic couple of years in terms of with the way things have. Who would have ever predicted what was happened in the last 2 years? So, you know, we're basically in an era of post-COVID. I think a lot of things have changed in a very dramatic way, whether it be working, the way we work, the way we shop, the way we. So there's so much, you know, the way we live, what we demand from our spaces in terms of, better homes to live in and basically spend time with our family as well as working. So it's really marking a shift, I think, in a sort of, like literally in the last. I don't think there's going to be such a shift in terms of the way we have to relook at things moving forward. But having said that, I think there's a lot of opportunity, and that's primarily the sort of areas that we are looking at the moment, which is sort of addressing all of those that shift in the way we work and the way we live. And so we are very, very bullish about especially housing, multi-family housing. I think there's going to be a big demand for communal housing and also offices in terms of really looking at how that model is going to change.
Yeah, go ahead, Mr. Dan.
First, thank you very much. Honored to be here, and it's a pleasure. And I really enjoyed Riyadh. I've been here like 2 years, and it's really nice. I think that there is two things that mainly happening. One is the cycles are becoming very fast, and usually real estate is more like a long-term investment. And I think that what happened now with COVID and change of regulations is shifting things, and you really need to be on the ground in a very specific local market to understand what's going on. So, as you said, work from home changed a lot of things, and then it changed those neighborhoods, because places that were more mainly office buildings, like, you go to New York, you go to the financial district, it's nothing, there's no people, everything is empty, shops are closed, and you go to a residential neighborhood and all the people are back to homes and people are back working. So there's a lot of changes and a lot of things that you really need to be on the ground and to understand what's going on. And if you go also to a place like the United States, you think it's one country, but each state basically had different regulations, and the cycle was different. So if you go to a place like, without going into the politics, what's right and what's wrong, but you go to a place like New York that was very strict with COVID and regulation, and you see that basically people were leaving. And a place like Florida that was the complete opposite, everything was open and people are moving there. So it's, of course, it's changing a lot, the real estate, and it's changing. So a place like Florida, real estate, rents went up in 2021 between 20 to 30% up in 1 year. So all the markets are really changing, and it's really incredible to see, but really need to be, as you said, there's a lot of opportunities, but there's a lot of risks that we need to understand. The second thing, quickly, is the interest rate. The interest rate is very low for a few years, and it inflates everything, as you can see on the markets, real estate. Basically, there's no alternative, so people are putting money in where they are. So also here, need to be careful what's real market and what's just inflated because of cheap money and cheap leverage that's coming in.
So what would be the real market versus the hype market? What are the, is it unit related or is it geographically related? How could you decide what's the right price based on inflation, or is it just the real price of the asset?
So I think that if you look what we're doing, we are like selling a lot of multifamily that we bought in last year. We're actually closing today on 5 properties, like 1,500 units that we bought from Lehman Brothers from bankruptcy. We're selling them today in Dallas. And we're selling them, if people understand the meaning, we're selling them at cap rate 3. In my opinion, someone that buys an old product, a multifamily at cap rate 3, it means that he's just doing it because he can get financing at 2%, which is driven, it's basically, I think it's inflated. I mean, time will tell. On the other end, you know, we have now in New York, you can never buy a new tower building in Brooklyn that is bankrupt because people left, and I believe New York will stay New York, so you can buy it, and when it stabilizes, it's like over cap 5. So to me, I think that it's an opportunity to sell the things that I think that are overpriced and go again back to buy to the places that are more distressed, and it makes more sense, not just because the interest rate is low.
Mr. Yasser?
In terms of?
Yeah, in terms of what to look for when you're like investing into real estate. How do you evaluate the opportunity, right? What are like the takeaway signals?
Yeah, I think we look at every deal as on a deal-by-deal basis. So it's every single deal has its own unique, you know, sort of opportunity sets. And you know, from our perspective, we are very much geared towards development. So we take on development risk. We look for assets that we can either reposition or that we can come in at a very low entry level and add value to, and then reposition it back into the market and secure, you know, north, so between 5 to 6, whether it be sort of commercial office or you know, whether it's a student building, which is another area we're active in. Again, around that sort of same level in terms of cap rate. But we have 2 strategies. One is a growth strategy, which is very much more around the sort of development, taking on development risk and adding value. And another one which is much more towards buy and hold yield.
I think we are basically similar. We have 2 strategies. So we're buying in New York on more value that you can buy cheap existing product and sometimes add value, and sometimes it's just financial play. Like, you know, we bought in East Village properties, 71 units, wasn't big, but just all the kids went home. They all work in Apple, Google, and studying NYU. And during COVID, they all left. So the landlord couldn't even pay the mortgage. He had 30% vacancy. So he just took the opportunity and bought it cheap. On the other end, in Florida, we're doing development where is the growth, because it's like so many people are moving there. And what happens is if you go to the prime locations, like in Miami, so a place like Brickell that, you know, suddenly has rents like New York. So all the people that were local before are pushed out. People with lots of money from New York, from California are coming. And for them, it's nothing. It's more money to buy an apartment. So the locals are pushed to the next neighborhood. So I think there's a lot of growth that's coming there. So it's 2 strategies in different locations.
So globally, let's speak on a little bit more of a global scale. What are the underrated investments that are under the radar right now that you can get in at a very underpriced premium? Mr. Yasser?
Definitely commercial office is an area that's under stress. I'd say you know, in the main prime cities, even global cities around the world, there's a big stress on that. So I think, you know, there's a lot of stock which needs to be brought up to standard. So you can play in that area in terms of finding assets which are sort of, you know, they're just not up to the same kind of level of standard in terms of meeting whether they be COVID issues or whether they be sustainable. you know, ESG issues in terms of, you know, issues to do with, you know, reducing energy loads on a building. These are all like kind of areas that you know, you could potentially tap into and address, and then perhaps gain some upside, because there are definitely tenants who are looking for that, those type of assets.
So, Mr. Yasser, geographically, which part of the globe are we talking about? So, commercial units for everybody that just joining us now after lunch. Commercial spaces, offices, very underrated, very under the radar. Which part of the globe are we talking about?
Well, we look at the moment we still operate in the UK, so we look at sort of secondary UK, you know, sort of locations, not necessarily like London, but you know, because we look at areas where there's been a trend, I think, specifically in the UK, and I think it also, you can say it's mirrored everywhere, in some other areas. We've heard this in the US as well. People migrating away from more expensive locations like prime cities, like New York, and moving towards areas where they can actually have a better lifestyle but still be within commutable distance of a London. So we look at, you know, so Bristol in the UK is one area we're just about to close on our exit on a deal there, which we took on just prior to COVID, and we managed to effectively redevelop, refurbish, and then essentially put it back on the market. Given all the headwinds of COVID, we managed to achieve it. So it's hopefully going to complete today. So these are the areas that we are, you know, that's an area we look at, because it's an area we know. I would probably advise any investor to only operate in some spaces that they kind of really understand, really know their space well.
I agree with that. Yeah. It's like always, it's like a lot of people think that it's like, you know, they bought sometime an apartment or something, so they understand the industry, and it's totally a lot of changes, a lot of things. So really need to really understand the things. And I think that if you look at the trends, I think work from home is not going to be extreme like it's now with all the lockdowns, but I think it's here to stay in some kind of hybrid hours, flexibility. So homes needs to be with more amenities, more bigger space. And we see it, like for instance, we changed in in a few of the buildings. Actually, we have we took things that were lounge and made them like a small WeWork in the lobby of the building. And it's actually helped us to get more tenants, because people say, okay, I'm working from home, you know, I can't be really in this small apartment with my wife and the children, and now I have this working space. So that's one example. A second example is, I think that what's happening today with a lot because of the interest rate and other things, the gap between wealthy and poor is becoming bigger and bigger. It's true all over the world, you know, the stock market and everything else. So we are targeting more the Class A, we are less playing on the Class B and C. So the Class A people are coming now with a lot of money, and they want everything ready. So if you think that didn't happen in the past, people are willing to pay more rent or to pay higher prices if everything is ready, everything is nice, everything is as they want to. They don't want even to invest. Even things that, you know, you used to be like middle class. They say, okay, I buy an apartment that is so-so, and I'll invest money, I'll upgrade it. They don't want to do it, they come with the money, just want to have everything ready. So when you're investing or preparing a property or building, you have to be ready to this clientele, because that's their need today.
I think also, I would like to also stress that, you know, Saudi as well, you know, in terms of another area we've been working in very closely, and we just prior to COVID, we completed on a communal housing project, which was actually supposed to be for expats.
Louder, yes, thank you.
It was supposed to be for expats, and actually we ended up leasing it all to Saudis. And it was actually an interesting experiment in a sense that it was actually a very open community concept, and with co-working unit in the middle. And I think there is a huge potential in Saudi for that type of thing, like sort of the multi-family model, but you know, sort of for Saudi families who want to be part of a community, who want to basically still engage with each other and have facilities and have the ability to also work from home. And you know, as we know, like, you know, there's been some major changes in terms of you know, the way that society is evolving here. So, you know, it's, you know, we see more and more so here even, you know, the typical nuclear family changing in the sense that, you know, there's less reliance on maids, drivers. It's all very, you know, it's becoming much more community of almost self-sufficiency, and, you know, the things that you can more or less do now from your house is unlimited in terms of ordering, or, you know. So it's a very, very interesting era, I think, in terms of real estate. I think whether it be regionally, whether it be globally, I think there's a huge scope for, from my perspective as an architect, I like, you know, to look at things from a design perspective. I think there's huge, you know, possibilities for, you know, from return and design, you know, commercial and, you know, creative, to actually do something very, with huge potential.
Mr. Danny, the sleeper investments, what with the underrated, under radar, what are we looking at?
So I think it's one is the more apartments, especially in like a place like New York, for the young people, because New York is coming back, but not everything is coming back. So the young people are coming back to the city, to the universities, to work in the high tech, but wealthy people are leaving because the taxes are high. So when you look at the neighborhoods and the type of investment, you need to understand that. So I think that the growth will be there still with the young people, and there, a lot of them are not married, you know, like the marriage age in New York is going up, and some of them one child or not. So, you know, small apartments, very cool with all the amenities in the areas which are more like cool for them. That's, I think, an opportunity. And second is in the places, as we spoke before, with the growth. So like you said about Saudi, if you go to Florida, Florida always was international, but always was people from Latin America. The last 2 years, all the growth is coming from the US. People, Americans that are moving to Florida and buying their homes and actually making them their home. But again, you have like, it's like weird, if you look at the map of Miami, you have good neighborhoods, and next to them a place that is like nothing, and it's like 1 kilometer, and with land that you can buy, in my opinion, ridiculous prices, and you can build, and the city is very friendly. So this is something that, you know, I think is, people don't look enough and say, okay, instead of just buying these high rises and this in prime location, you can buy sometimes half a kilometer from that the land with a ridiculous price per unit and build it and like really create value. So I think that's, at least in markets that we work, I see the opportunity.
That's great. Let's say somebody comes to you with a bag of like $500 million right downstairs. How would you deploy it? Would you deploy it all into one property, or would you like maybe 500 million is too little? 1 billion?
500 million?
Yes.
All at once?
Yeah, all at once. A bag. Okay, how would you deploy it?
I would, that's a good question. I think you would obviously not put it all into one project. It's, you know, you'd have to be, you know, I'm a great believer in not putting all your eggs in one basket. You know, no matter how emotional the situation is, or I think you'd probably, the wise thing to do would be to have a very clear diversification strategy. I mean, our real estate allocation is pretty much chopped up into 3 pieces. So we have like, I would probably allocate a third to liquid strategies like REITs, something like that, which pays out.
Sorry, Mr. Yonder, I didn't get it. Liquid strategies?
Liquid strategies like REITs, to a third of that, and then a third probably to some illiquid sort of fund strategies, to sort of more thematic strategies perhaps, to things that you want to get exposure to, like maybe things that you don't have the capability to deploy directly into yourself, be in control of. So for example, we do that on the scale of, for example, like data storage, or whether it's logistics, you know, through a fund vehicle. And then I'd probably have a third of that probably into more direct real estate development strategies, where I'm actually, you know, rolling up my sleeves and on a one-on-one basis getting involved on a daily basis, actually, on a sort of more direct level?
I think that one of the biggest risks now in the market is inflation and interest rates. And that's why I also like apartments, because apartments, the rent is every year is a new rent. So basically you can increase, and that's hedging you from inflation, which I don't know other products that are doing it. People say gold, sometimes maybe now Bitcoin, although I don't know to say anything intelligent about Bitcoin.
Sinking to $40,000.
But I think so. Apartments, I think, is a good place now to do that. Capital markets, which was some of our strategies, I'm afraid. I think it's the markets generally are inflated, and I think that they will be forced to go with interest rate high because inflation is it's a big threat. You know, and a lot of in the U.S. is run by politics. So if inflation can continue like this, probably the Democratic Party is going to lose in the midterm. So they will have to fight it. They will have to increase interest rate, and this can make a big correction in the market. So I would say I would do apartments, existing ones, and land, because I think land is very cheap now versus in what's going on, and it's like a shortage. And I would keep maybe a third liquid for opportunities when the market corrects.
Can you please explain to everybody here, how does the interest rate by the Fed affect the price of property?
So basically, most of the real estate is leverage, right? You buy it with interest.
With a loan, yes.
With a loan, with a mortgage. Now let's say that there is 3-4 competing funds, like what we sold in Dallas, right? We sold in Dallas now these properties. So someone like, I can mention the name, someone like Blackstone comes, and they can borrow at 1.5%. So if they can borrow at 1.5%, they can willing to pay more because they see enough return, even if they're buying it at cap rate 3, they still see 1.5% spread, while someone else that can borrow only 2.5% or 3% needs to have a lower price in order to make return. So basically, the leverage is key here in real estate, especially in the yielding. So what happened is because people could borrow cheaply, and they leveraged, and the banks were less disciplined, so they're willing to pay. And now what's happening is that when the markets, if you go to the S&P, and the average stock is traded at 30 multiplier of 30, so you can buy real estate at cap 3 and finance it at 1.5%, it looks like an amazing deal. But of course, when the interest rate will go up, it can reverse. So if the interest rate goes back to a mortgage with 4%, and you bought the asset with 3% yield, you're basically bankrupt.
And since that is on the horizon, can one argue that another housing bubble is on the immediate horizon or within the next 2 years? In terms of like the end of the cycle?
I think, are you talking globally or?
Globally, and mainly because the U.S., whatever happens in the U.S., fortunately or unfortunately, affects what happens in the rest of the world. So do you think like we're closer to a bubble or a crisis of some sort?
The house prices are, I mean, in terms of housing, I think there's still a huge shortage. I think globally, I would probably say there's a huge shortage of affordable housing, I think. So there's always going to be a demand. I think a lot of the demand that's driving family housing is to do with that shortage, I think so. Housing bubble, the kind that we saw before, I'm not sure if it's anywhere yet on the cards. But
I agree, there's a big shortage. In the US, there's a huge shortage of apartments. They're not building enough. And because a lot of things become more complicated, like, the previous panel was talking about how they want to make Saudi more simple. In the US, they're going the other direction. More red tape and more bureaucracy and more things. So it's like, in New York, you buy land until you start to build. It's like, it can be 2-3 years. It's like a very long process. So for a developer, it's a huge risk because, you buy land and you deliver the product in 5-6 years. Who knows what's going to be the world? We don't know what's going to be tomorrow. So I think that there is a huge shortage of apartments, but also need to understand the differences because, as I said before, the wealth gap is so big. You go to New York In the Upper East Side, the prices are already pre-pandemic prices. The rents are even higher. You go half a kilometer there to Harlem, and you can rent for 20% less than it was last year because no one wants to be there because what's happening. So it's very, very local business. Really need to understand. It's almost every street and every neighborhood has its own things or opportunities or risks.
So then how do you decide on your investment strategy when everything is different?
We are basically, like you said, basically it's a project by project. So we always check first the project itself, then the micro, area, and then the area, and then also the politics that around it and the regulations. So basically, it can be, there's so many things that you can happen, like, I'll give you an example that people that are not familiar, you buy an area and there is a plan to put a homeless shelter there. Okay, and again, you're not going to why they're doing it, if it's right or if it's wrong. But you're a real estate owner, you don't want the homeless shelter to be next to your value. So you really need to really check project by project what's the opportunities and the risks.
Great. Okay, closing remarks, Mr. Yasser.
No, I think, like I said in the opening remark, it's been a tremendously challenging in the last couple of years. And I think what I'd like probably to leave the room with is the concept that we are very optimistic about the future. I think there's huge potential for if you're targeting the right sector, whether it be in Saudi, we're also actively involved here in hospitality, which is a hugely exciting area for us in Jeddah. So it's you really have to be aware of all the risks and do your due diligence correctly, ensure that you're managing those risks, and basically come up with a good product. I think and that's really I think here this is one of the keys. I think it's the standards are constantly being shifted in a very positive direction here. So year by year, it's always challenging. But I think here, we're going to see a huge improvement in quality of deliverable project. And I think the industry, the procurement industry, the contractors industry here has to step up to the challenges that are because there's a huge amount of talk about international players coming in, and the local real estate developers really have to step up their game here to ensure that they're always going to be up to par with whatever is going to be coming, whether it's done publicly through governmental incentives or whether it's through initiatives with international players. So what I'd like to just say is that there's a huge optimism, I hope, at this stage towards real estate in general.
I agree. I think that there's great opportunities coming, and I think now with hopefully with the last variant of the Omicron, where the pandemic is behind us, and with all the changes in the geopolitics and the work from home and everything, I think it's a good time, and inflation and interest, I think it's a good time to look at your portfolio and your assets and asset class and to see if maybe it's a good time now to do some changes and take off the table some more risky or inflated assets and invest in more places that you think that there is growth and opportunity. I think we are actually in this crossroad now, which is a good time to do it.
From the sounds of it, there's a couple of buildings in New York that you can make a ton of money on. Thank you very much.
Thanks.
Ladies and gentlemen, please thank Danny Fishman and Mr. Yasser Al-Sahil. Thank you very much.